The financial system does not reward saving cash over the long haul. In this lesson, I'm going to show you how the value of cash is destroyed over time. This is the buying power of $1 over the past 100 years. And if we follow the chart, we can see that $1 100 years ago is only worth about 5 cents today. And what this means is over the past 100 years, with an average inflation rate of around 3%, prices have went up 1,745%. The average price of a house in the US is around $400,000, which in 1924 would cost you around $22,000. What this means is a dollar today only buys about 5.5% of what it could buy back then. Let's go back to 1975 to see how $100,000 in cash retained its value. $100,000 as of today would only be $15,770. That is an 80% reduction in buying power over a span of 50 years. Let's say you won the lottery, $1 million in 1975, but decided to hold it in cash over the next 50 years. Over the next 50 years, your $1 million would dwindle down to just over $150,000. This is an average yearly inflation rate of about 3.7%. But over the 50 years, prices increased 486%. This is the equivalent of $1 over that period of time only being worth 16 cents, which means if that $1 million kept up with inflation, it would have grown to 5.8 million. Now, if we just look over the past 5 years, inflation increased around 23.5%, with an average inflation rate of around 4.31% a year. So if in 2019 you had $100,000 in cash, it would only be worth $80,000. So the moral of the story is that your cash loses about 3% a year. Over the past 10 years, it's lost a total of 33%. So from 2014, your dollar is only worth about 75 cents. Your cash needs to gain at least 3% just to break even. You don't gain any purchasing power unless whatever you're invested in is gaining more than inflation. And this is why it's in everyone's best interest to invest as much as they can. If not, the system will absolutely rob you. And don't worry, I'll make sure to have this website in the show notes so you can do further research. We want to invest in the best assets that outpace inflation. And if we go back to the 1970s, we can see how investing in cash, real estate, bonds, gold, corporate bonds, and the S&P 500 performed over the next 53 years. Now, since the 1970s, the S&P 500 has significantly outperformed other assets. $100 invested in the S&P 500 over 53 years would give you around $22,500. Now, the reason the stock market outperforms other asset classes is because it has a higher growth rate. As inflation increases over time with an average rate of around 3 to 4% a year, the stock market increases with an average rate of around 10% a year, although some decades can underperform. For example, in the 2000s, the S&P returned negative 0.9%. In the 1990s, the average annual return for the S&P was 18%. 2013, the S&P gained 32.5%. In 2021, it gained 26.9%. So each year is different, but on average, the S&P returns around 10%. And this is versus the average inflation rate over the last 100 years, which is around 3%. And since the 2020 COVID pandemic, the response from the government pushed inflation to an average rate of 5% a year. Now, since the pandemic, prices have gained a total of 23%. And in that same period of time, the S&P 500 has gained around 175%. History proves that over the long haul, it's much riskier to not invest.